So someone came along today and put a gun to my head and they said, you can only have one indicator on your chart. You can have price, you can have volume, and you can have one indicator that's a derivative of one of those two. So you can choose anything. RSI, moving average, Bollinger Band, stochastic, any of these things. What would that one indicator be? Without any shadow of a doubt, it would be the volume weighted average price, or VWAP for short. Now, why is that? Now, I think the volume weighted average price is one of the most underused indicators out there. It wasn't until very recently it became native to chart packages, and actually, quite often you had to program your own code to get it to work. Now, why is it so important? Now, the reason VWAP works so well is it's a moving average, but it's based on volume. So in other words, it's not just price-based moving average. So if you've got 1, 2, 3, 4, 5, and you've got a 5 period, it's taking the sum of those and dividing by 5 and just giving you a pure average, like a moving average does. The volume weighted average price is saying, listen, there was 10 traded here, there was 1,000 contracts traded here, 1 traded there, 2 traded here, 50 traded here. It's going to give a lot more weighting to the price point that traded the most contracts, and it's going to represent that in the actual indicator that it's displaying. And that to me is so much more powerful because it's showing you where more people are engaged and involved. If you just got price, you can have price moving on, you can have like 2 or 3 contracts trading, but unfortunately, moving average is still giving you the same value. It's still giving the same weighting to perhaps an hour earlier where you just have millions trading at a level. So why is that important? Well, that's important because I know that institutions are looking at the volume weighted average price for various reasons. One, algorithms have it in their code. They are programmed to beat the VWAP. They're programmed to match the VWAP. So they're looking at the volume traded, the price, and then they're splitting the order up and using sliced orders relative to VWAP. So I know that's happening. I know that traders who are executing from a human perspective are still trying to look at the VWAP. At the end of the day, if you've got a big order and you're trying to spread it out over a few days, how do you benchmark it? You benchmark it by saying what was the average price traded based on volume in the day, not the high minus the low divided by 2. You want to say, well, where was the volume traded? That's no use if, like, in the upper quadrant, first quadrant, you just had no volume traded. There's no possibility of you getting any liquidity there. So it makes sense why that's a benchmark. And not only that, it works so well. In certain conditions, it's just such a beautiful, beautiful tool. And I'll go into it some more depth, some really intricate depth, some strategies for it. But broadly speaking, like if you look here, let's use a 15-minute chart. You can see how often price really does get, responds to the VWAP, and even, today or yesterday or the day before, you can just see that, there's always, it's where supply demand shifts. Good move to the downside, tags the VWAP, and that's kind of constrains price a little bit. Here we stalled for a good half an hour before rolling over. Here tagged it. Here went a little bit lower. Here we constrained price after a good excursion. Here we constrained price. Okay, I'm not cherry picking the best examples, and I say I'll go into some more depth another day. But actually, here's a good one while we're here, and it's up on my screen. I can't not show you this one. This is kind of the idea you're looking for. The big excursion away from the VWAP, the push back to the VWAP, the volume weighted average price, the tag or the nearby. People perceive that as value. Because if you've had a good move away from what's really the correct mean, because it's weighted by volume, and then it pushes back to that level, that then becomes a reasonably good value scenario, if you like. And you can see why that's value, because it's where the majority of trades done based on an average. From a longs perspective, it's a good place to add more. From shorts perspective, it's a good place to cover the short from if you're trading, mean reversion, i.e., outside in, so it's pushing up, you're looking for an extension back. It's a good place to say, well, that's a kind of mean for the day. I'm going to look to cover it. It makes a lot of sense, logically, as well as just if you've traded it from any period of time, knowing how good it is. Now, same with any indicator. You can't use it all the time. There are strategies, really powerful strategies for using it in range-bound markets, and there are really powerful strategies for using it in trending markets, but you've got to know the difference between the two and how to quantify it. But I really would urge you to do some more research about the volume weighted average price. Get it on your charts. Look out for more videos as well. We'll talk about it in some more depth. But it's something that's really underutilized, something that's really important. And if you can use anything, then I would say this is the one thing that you should use.